Hi, so I'm representing on Alimera Sciences. They are a biopharmaceutical company located in Georgia. They were founded in 2003 and had their IPO in 2010. Um, they focus on developing drugs for the retina, as well as any diseases involving the back of the eye. Their primary focus is just research and development of drugs, and they don't have that much manufacturing and commercialization of drug involved. So they usually license their patents to other manufacturers. They currently leverage at a 15% debt to market value ratio, which is also a 64.66 debt and equity book value ratio. Uh, so going forward, some key assumptions that I made that in my model was that they recently just released a new drug called Illuvian, which is expected to do well in the current market with revenue projections for the next 2 years about 35 million and 80 million. Previously, Alimera had little to no revenues at all. Um, so also, since they are a pharmaceutical industry, they do not invest much into um, property, plant, and equipment. So they have little capital expenditure, but instead they invest a lot of their resources into research and development. So their fixed costs are extremely high, and that's just within research and development. This also includes SG&A costs that are about 10 million um, for the past 2 years. Um, Marketing costs have rapidly increased to about 15 and 20 million dollars, and I expect research and development costs to grow rapidly as well as they try to expand their drug portfolio in the future. Which brings me to the next point where I believe since they will be able to develop new drugs going forward, since the market has a great amount of faith in them in terms of their research and development, with a market capitalization of 200 million and their research development costing about 10 million currently. That's growing to be about, and growing in the future. I have them projected about 20 to 30 million in research and development expenses per year. So this shows me that the market has a great amount of faith in terms of their ability to develop new useful drugs, and also on their company's website they also have a strong public commitment to developing drugs and benefits towards any issues with the eyes. So they have a strong commitment for developing drugs in the future as well. Because of these high fixed costs, earning revenues each year can be very difficult as well, especially since they just released their first drug. Even with the new release, making earnings is still difficult as analysts have them projected to have an EPS of negative 0.35 and 0.26 for the next 2 years. My model has similar projections of negative 0.31 and $0.21 per share going forwards for the next 2 years in terms of EPS. Um, Another key assumption I made was that they would have a 40% tax rate um, in this model. I did not choose to use a lower tax rate because for the one, they don't have any deferred tax assets as they have evaluated all their previous losses and expenses, net loss. They had a valuation allowance that pretty much negated all their deferred tax assets, which is a concerning sign in a way because that means they have, in order to not show that on the balance sheet, that means they believe there's a less than 50% chance that they will be able to use these assets going forward, the deferred tax asset. So the fact they don't have any deferred tax asset, and I do have them making earnings, a little bit of earnings overall going forward, I decided to use just a general rate of 40% tax rate, which is consisted of the 35% for federal and 5% of state and local. So the beta for our value for the company was approximately 1.2, and I took this beta by taking the unlevered betas of all the comparable firms, about 42 comparable firms within the industry and towards Alimera, unlevered it and averaged the asset beta, and it came out to be 1.2. I going forwards with a risk-free rate of 2.224 from the treasury bills, as well as a market risk premium of 5.04 based on the industry, according to FactSet. So in my capital structure, it seems beneficial for Alimera to keep on leveraging their debt, as they would always keep on increasing their firm value. They can easily increase it up to from 15.0 to 15.0% to 17.5%, and still be able to maintain the same credit rating while increasing firm value. And they can go beyond that, go below the current credit rating of BBB and increase the firm value. But that's not my recommendation. My recommendation is for them to unlever from 15% down to 6.25% in order to raise their credit rating to an A plus. This is very important to me because there are other considerations within my current model that is not taken account for. One, because it's a young pharmaceutical company, management should be more concerned about trying to diversify their drug portfolio and try to find research and developing new drugs and such going forward for long-term growth. And if management has to worry about year to year about paying off taxes, I don't think this would be beneficial for them in terms of their long-term success if they don't have their sights on that, but rather focus on the year-to-year situation of their debt. Another key component is just having the ability of, with a high credit rating, that they'll be able to leverage and use debt financing for any research and development expenses, unexpected research and R&D expenses, or any other unexpected causes where they need to invest a lot of money or use a lot of money. And this is an important fact because they just last year had to use leverage from about an 8 million debt to the current 32 million debt, which was primarily their primary cited reason was because of they needed the money to continue with the critical development of Illuvian, as well as paying off past debt with Svidia. So so this is why I believe as they develop new drugs, it's going to become critical that they have the flexibility to debt finance any unexpected R&D expenses, as well as just financing their future drug products and developing them. So that's very key in my opinion, in my recommendations of why they should unleverage it. So my dividend policy, so Alimera currently does not distribute dividends, and in my recommendation, I do agree with this policy, and I would recommend that they maintain this policy of not issuing out any dividends. This is because they currently have for next 8 to 9 years, they have very volatile earnings, and paying out dividends when you're struggling to make a net profit during this period is very unwise. And I believe investing within their own company and their own projects would net a higher return going forwards. And just going from, based on my model, reinvesting into share buyback alone increased the returns by the year 10 more than it did by dividends by year 10. So these are my two big recommendations. Is just to wrap up and summarize is, oh, I'll go with IPO next. But Alimera, they need to leverage it down from 15% market value down to 6.25 market value in debt structure, and to maintain a no dividend policy, as they can have gained higher returns from reinvesting into the company, and they do not have the cash capacity to consistently pay dividends consistently at year to year, and to be able to pay growing dividends as well. In terms of their IPO had an initial offering at $11, and on that same day they closed at $11. However, this was less than the proposed range of $15 to $17. This shows to me that management was concerned that they would not be able to, the market did not evaluate them as highly as their bank, their lead underwriter bank, which is Credit Suisse and Citigroup. And Credit Suisse was the lead one. So this possibly was an aggressive proposed range by Credit Suisse, and as you can see, management had a correct prediction evaluation at $11 as it was closed at $11 that same day. However, over the next 3 years, the stock did not earn a positive return and earned a negative 73.54 return, as opposed to its industry where it earned 46.08 return, and the market earning a 32.01 return. So there's a quite discrepancy where Alimera's stock price dropped down while the rest of the market and the industry went up. Especially Alimera's industry outperformed the market. The primary loss incurred just within the first and a half year was the IPO in April 20th, 22nd, 21st in 2010. By November 25th in 2011, it has dropped at sharpest decrease all the way down to $2.22. But since then, Alimera has traded upwards. So the total of a return from the IPO isn't as bad as the negative 60.36%. Still negative, but they have been improving upwards, while the pharmaceutical industry has performed at a 95.81% since Alimera's IPO, as well as the market increasing by 76.24%. However, not only has Alimera trended upwards for the past 3.5 years, I believe they have great potential and are poised in a situation with the new release of Valuation to have a strong increase in terms of their stock price going forwards in the next couple years. In my model, they have a current price of about 4.86, which approximates the current price, and by year 10, I have them reaching at $9.78. So this concludes my presentation and my recommendations on Alimera Sciences. Thank you.